it was a day of divided opinion for Indian markets. Large cap stocks, they moved in line with global markets, but mid cap stocks and especially handful of small cap stocks, they saw some serious price damage. So what led to today's rampant selling in mid cap stocks and into the run up to the budget? What exactly are markets factoring in? We'll discuss that for you and much more on this edition of Markets Tomorrow. My guest lineup for the day includes, we've got a voice for you from the house of Goldman Sachs, Timothy Mu, Chief Asia Pacific Strategist with Goldman Sachs Asia, Vibhav Kapoor, Group Chief Investment Officer with ILNFS, and to give us a better understanding of market technicals, Sandeep Wagle, Founder and Managing Director of Apatat Technical Advisory. Gentlemen, good evening to all of you. Thank you for joining us. Sandeep Wagle, let me kickstart the discussion with you. We can easily divide the market into two. The large cap market, which was safe and sound, and the mid cap market, so the small cap market, which really got disseminated.
Absolutely, Nikunj. I mean, there is no point in talking about some of the mid caps. I mean, you talked of that stock Core Education, which fell by almost 150-200 rupees. Very, very scary. Having said that, the large cap is still range bound, but the bias is now changed to on the downside. I mean, I think 5900, 5930, the Nifty will find it very difficult to cross. I mean, in spite of whatever positive, if at all, it comes in the budget. And I think if we get a chance, I think one should go short around there or sell around there. And on the downside, 5770 is what we have been talking of. So that remains the range. But I won't be surprised if post-budget or on the day of the budget, we may see a downside or a crackdown to probably even 5650, 5640, that range. So broadly, I am talking of 5650 to 5850, 59. And nearer 59, I am comfortable selling or going short.
And bear in mind that this year's budget is also coinciding with the FNO expiry. So on the budget day, you could see a lot of back and forth action and a lot of volatility. Vibhav, this question is coming your way. Do you think Indian markets in the near term have hit some kind of a stumbling block because large cap stocks underperforming global markets and mid cap stocks have got disseminated?
Yeah, there is clear evidence of that underperformance in the last 6 or 8 weeks since the beginning of this year. And I think the result season which ended a few days ago, I think that was really one large factor in that underperformance because I think the result season was much worse than what analysts had expected. And that sort of gave evidence to the fact that things on the ground have not improved all that much so far. And probably the market had run ahead of expectations based on the announcements which the government was making for the last few months. So I think definitely yes, there is evidence of that underperformance and I think that underperformance can continue for some more time.
Timothy, let me also encourage you to join in the discussion. At the current juncture, how would you stack risk versus reward ratio for Indian markets? And are you still of the view that Nifty in this calendar year will cross 7,000?
Yes, we do. We think that's a reasonable target and we can get there without a lot of sort of mental gymnastics. It's pretty straightforward. We think that earnings growth will begin to pick up in India both for this year and for next as the economy begins to recover momentum, which is a key underlying assumption and something which I'm sure we'll discuss a bit further. The valuations for India right now we think are very justifiable. They're 13, 14 times forward earnings depending upon sort of which day and exactly how you're measuring the earnings. But those sorts of valuations are reasonable. There's a variety of approaches that we can use to justify that sort of level. So from here to get to that 7,000 Nifty target would basically entail riding the underlying earnings slope and maybe having a tad of valuation expansion from here, but nothing that stretches the imagination unduly. So we think that's a credible sense of direction and magnitude for the Indian market to get to if indeed we get the kind of fundamental developments that we are looking for.
Vibhav, are you a big fan of large cap IT stocks? When we started the year, who would have thought that Infosys in this calendar year will appreciate by about 20% plus?
Yeah, no, we like the IT stocks, particularly the large caps, particularly at this point of time. Partly, as you said, because probably global situation is improving somewhat. That should be helpful to them. Also, I think two other factors. One is, as you said again, they're sort of defensive. They're not so much dependent upon the Indian economic cycle. and the Indian economic cycle is certainly not, taking off at this point of time. So there would be some shift strategically by fund managers to the defensive sectors, and IT appears to be defensive. Also, a third factor could be the rupee itself, because we do expect the rupee to weaken going forward because of various reasons like the global strength for the dollar, the increase in the current account deficit in India, and that would also be helpful for the IT companies. And I think there's clear evidence that, whatever while the Nifty index is staying sort of range bound, a lot of this is happening because, some sectors like IT are really pushing it up or preventing it from going down.
Vibhav, what are expectations from the railway budget? Do you expect the railway minister could, pull in a surprise?
No, I think, one thing is clear, that the dependence of the railways on the general budget, or what they call the gross budgetary support, is going to be lower because the government doesn't have that much money, additional money to give to the railways. So they'll have to depend on extra budgetary resources like borrowings. Even internal generation is not going to be all that great. So it's going to be a pretty state type of budget. It's difficult to increase freight rates also beyond a point, because then freight shift to the road, and that doesn't help the railways. The passenger rates have already gone up. So it's going to be, more of a routine type of budget, which will just keep the railways running.
More like a statement of account, and based on tomorrow's railway budget, I don't think we can also judge what is in store for us from Union Budget 2013. Sandeep, anything interesting from the railway basket, technically, which is looking strong, which is worth, where there is a trade which is there in the offing?
Nikunj, in fact, stocks like Carnex or Titagarh wagons, which normally move up before the budget, are looking weak. In fact, they have already given breakdowns. So I don't know what it is suggesting, but it does suggest that there is nothing very positive about the railway budget. But then probably it could also be that it is already discounted in the prices, and some more downside is what I expect, and that is also true with the trend of the Nifty and the overall market, including some of the mid caps that you have mentioned. So I don't think one should expect too much positive.
Vibhav, apart from the budget, what else could be the big trigger for Indian market?
Well, global, the way global markets behave, that's very important. At the end of this week, we have the US automatic cuts coming into force, unless the US Parliament does something about that before the 28th. So if that doesn't happen, I think global markets could also go in for a correction, if nothing else, and that could have a negative impact on the Indian markets. Of course, the global markets have been doing very well, but this could be an important issue. Today in the evening, we have the Italian Parliament results coming, which could also have some implications for the European markets going forward. And then, of course, we have the overall liquidity situation. If you look at maybe the 6 or 9 months from now, there is always that possibility that at some point of time, the US Fed will start to cut down on the stimulus, and that would obviously have very far-reaching implications for all global markets, including India.
Timothy, to your mind, at the current juncture, what are the key challenges for India?
Of course, there are many. It's India, right? So there are lots of things which can go awry, and that would include, on the political side or the policy side, lack of progress in terms of implementing some of the necessary changes and reforms. We're very much expecting some progress on the goods and services tax, for example. There's some other reforms with regard to subsidies that we'd like to see take place, perhaps in the energy space and so forth. So these are issues which invariably proceed slowly given the political process, and they're ones that we're hopeful we'll see some incremental progress on, but of course there are things which can go amiss. Also, we're expecting the RBI to gradually reduce rates as inflation comes down, but if inflation proves to be stickier and rates continue to be higher for longer, then that obviously would be an impediment to a growth recovery. And then, of course, there's the global environment overall. to which India is also sensitive, although less so than some other Asian economies. And that's something which, as I mentioned earlier, we're looking to improve. But if there are risks to that, then that obviously would weigh on the India recovery story. So there are a lot of intertwined factors here. Our base case is, as I've described, we're looking for the economy, both globally and in India, to begin to recover. That should drive a recovery in earnings growth. That in turn should impel a better investment mind frame. The animal spirit should get a little bit happier, and all that could bring us toward our nifty 7,000 target.
Sandeep Agle, what are your top ideas for tomorrow morning?
Well, Nikunj, I have got two ideas. One is a buy in HCL Tech, because the tech stocks are showing a lot of strength. So I see the traction continue. So I would have a buy in HCL Tech with a stop loss of 723, target of 757, and a sell in Aurobindo Pharma, which is given a breakdown towards the last hour of the day, and I expect the down move to continue. So sell Auro Pharma with a stop loss of 177, target of 165.
Vibhav, apart from IT, what else are you hot on?
No, right now I think we are very cautious on almost everything. Just the defensives, which is largely IT, and maybe a little bit of pharma.
Timothy, before we wrap, at the current juncture, what themes are you playing in India?
Broadly speaking, and very much consonant with what I just said, really the issue we're looking at is a recovery in economic momentum. All the work we've done in terms of analyzing the Indian equity market suggests that, of course, there are a lot of shorter-term factors that can influence the gyrations of the market. But if you look at the correlations with various macro factors over longer periods of time, it's pretty clear that India trades its domestic growth cycle. That is something which shows up very, very clearly in the data through a number of different cycles, and we don't see any reason why that shouldn't continue to hold. It makes all sorts of logical and economic sense, and it's something which we expect. So the key point here is that we need to see a convincing turn in the industrial production cycle.
All gentlemen, we'll leave it there. Vibhav Kapoor, Timothy Moose, Sandeep Agle, gentlemen, so good to have you on this edition of Markets Tomorrow. That's it on the show. I'm Nikunj Dalmia signing off. Thank you for watching this edition of Markets Tomorrow.